All right. Welcome back, everyone. Welcome to the Financial Philosophers podcast. Danny, good to see you again.
You as well, Chris. As
We,
always, awesome to be doing this. Always
Absolutely.
excited.
I'm particularly excited. This is a topic that seems everyone in the world thinks is really boring and unimportant, but I think it's super important, and I'm really excited to talk about it today. Today, we're talking about the Emergency Fund. So,
Okay. Yep, that is a staple of most finance programs, I will say.
yeah, definitely. I mean, I would argue it's a fundamental building block for one's financial security and even future success. That's one of the reasons why I think it's so important.
You would call it almost a form of insurance.
I have called it that before. Yeah, it's a lot of things. Surprisingly, it fills a lot of different gaps for different reasons. You could look at it as a form of self-insurance, right? Like at least for short-term reasons. If there were if your income were to stop for some reason, if you were to lose a job or whatever it may be. But it's a lot of different things. And for our listeners who may not know exactly what an emergency fund is, you've probably heard that term before, but we're going to dive into what it actually is, what purpose it serves, and why it's often underappreciated, why it is so important, and it's worth exploring a little more deeper than one would initially think they should. So, Danny, when you think of an emergency fund, what comes to mind? Like, what's the initial thought that comes to mind when you're trying to define what that is and what it does?
For me, it's always been kind of a combination of just a stack of cash. I mean, in a bank account. I do sometimes, I think that everyone should have a little bit of physical cash in their house if you can't get to the bank. But in general, the majority of your money should be kept in a savings account. But generally, I view an emergency fund as a way to kind of prepare against like really crazy medical expenses, possibly the loss of the total loss of a vehicle, and especially loss of a job. I think that's the primary way I've typically kind of viewed an emergency fund is if I lose my job, if my wife loses her job, if something's crazy with the economy, do we have enough to survive for the amount of time it will take us to find new employment? And so that's typically, what I viewed it as and how I use it is if something crazy happens, we can cover it without taking on credit card debt.
Yeah, I honestly I could not have said it better myself. I think I'm on the same page as you. I think there's a lot to explore with many things you said. If anyone goes online and Googles, how much money should I set aside for emergency, or what should I keep in my emergency fund? You're probably going to come across the standard rule of thumb, which is on hundreds of different web pages, which is keep 3 to 6 months of expenses set aside.
Yep. You're going to see one of two things. You're going to immediately see $1,000, and then you're going to see 3 to 6 months of expenses.
Yep. Yeah, that $1,000 comes primarily comes from Dave Ramsey's baby steps. And
there is a reason for that. That's the initial emergency fund goal. I will say that $1,000, though not enough for anyone long term, it is that first baby step. It's literally baby step one, right? So it's understandable that it is just $1,000.
Yes, I mean even as you go further down the baby steps, I think it's step 3. That's where Dave Ramsey says, okay, at this point, actually do shoot for that 3 to 6 month of expenses for your emergency fund. But you're right, $1,000 is a starter emergency fund. I actually think the $1,000 is a good psychological test too. Like there are some people, I think we've all been guilty of this at some point in our life, where you're saving money, right? And you see that bank account start to tick up in value, and it becomes really juicy and tempting to want to spend that money. Like, you know, it's like, oh, I can afford to buy this nice luxurious thing I've wanted for some time. I've got a couple thousand in the bank. What's it gonna hurt, right? I think that's an interesting first step. Is like, whoa. Can you actually hold on to the cash? Some people struggle to actually hold on to their cash.
True. It's not just about getting to that $1,000. It's about keeping it in there in perpetuity, right?
Yes.
You have to be able to maintain that balance and not dip into it unless there's a true emergency.
Yes. Yeah, it's a huge psychological test. But I do think it's a hurdle that everyone should strive to get past. I think a lot of listeners may hear this and they may be, beyond that at this point, but there may be listeners who this is an important step for them. And to those listeners, I would say, do set that as a goal for yourself, as just a baby step to try to get there. But let's take the conversation beyond that initial $1,000, right? So you hear this 3 to 6 months of expenses, and it's ubiquitous, right? Anywhere you go, everyone's talking about just keep 3 to 6 months of expenses. I was helping somebody once, a client, and I just dropped that line, right? Yeah, just set aside 3 to 6 months of expenses, right? And this was some years back. And this person said, Chris, what in the world does that even mean? What do you mean 3 to 6 months of expenses? Like, I want to go travel at some point this year. Like, I'm trying to save up for like a plane ticket and also a trip, internationally. Like, does that fall into my 3 to 6 months of expenses? Like, it's not.
Yeah, my
it's
argument
not as
would always
clear.
be no.
Okay,
Personally,
yeah. So
I would argue no, but
I know, this is the problem with trying to follow a rule of thumb, right?
Mhm.
Like, it's not always clear what that means, right? Like, 3 to 6 months of expenses is, I would argue is not clear, and it may be doing a disservice to people when we generalize it to just saying 3 to 6 months of expenses. And
Okay.
let's break that down. So
yeah. So how do we dive into that detail? What is the, I guess, kind of itemized emergency fund?
yeah, so imagine your income stops today. Like you had mentioned at the beginning of this episode, it's for those times that if I were to lose my job and we don't have any employment, how are we going to bridge that gap until we find another place to work and actually restart our income? Let's say that happens to you today. And not just you, Danny, also any listeners, you can take part in this exercise. Like, when we say 3 to 6 months of expenses, does that include your essential expenses, also known as your non-discretionary, right? I would say everyone should probably answer yes, right? This is things like your rent or your mortgage, or debt payments you may have to make, debt obligations, or groceries, right? Like, that's probably considered an essential expense for most people. Utilities, electricity, right? I think most people would agree that we need to cover those. That needs to be included in the 3 to 6 months of expenses. And a quick side note, this also assumes that you know what your expenses are. Like, you have some form of a budget listed out. You
That's
know,
true.
Relatively
You have
speaking.
to have completed some of the budgeting we talked about before.
Yes.
If you don't know what your expenses are, you cannot account for them.
Correct. Yeah. And I would say, the next question to the essential expenses is like, okay, well, what percentage do you need to cover them? Like, do you need to cover 100% of essential expenses? It seems like a silly question. I would answer yes, in my opinion.
I agree.
'Cause
I would also
I
say
think-
yes.
Yeah, I think by definition, essential literally means you cannot get by without those expenses.
No,
being
you have
paid.
to pay for electricity. You need to pay for your water. You're going to have to buy some food.
Yes. But what about discretionary expenses, right? Are those included in 3 to 6 months of expenses? These are things like entertainment or dining out or luxuries or travel, vacation, things like that. What are your thoughts on that?
So, right off the bat, you could. I personally do not. I view discretionary expenses as just that, discretionary. I'm
Mm-hmm.
not going to account for them within my designated emergency fund. My
Got it.
thought is if I have to live off of my emergency fund or I'm using it for a specific purpose, something, a huge emergency happens, then my discretionary spending stops for that time. Um, and I have a separate section of my savings account that is discretionary spending, but it does not touch my emergency fund. And I've begun allocating and creating different sections. So I have a general emergency fund. I have a fund
Mm-hmm.
where I save for taxes, so I
Mm-hmm.
don't get hit by some, like unforeseen bill. I have a
Right.
fund where I'm saving for car repairs, for house repairs. Those are each, they're all separate. And then a vacation fund. And every month I drip a set amount of money into all five of those. And then I have a separate savings account that's kind of the liquid discretionary savings.
Mm.
And that discretionary fund is made up of any money that I am not moving into investments. So
Got it.
if something happened, no, I wouldn't be spending discretionary. I would be subsisting until we had kind of recreated those revenue sources again.
Yeah. And that's this. I think when it comes to the discretionary piece, this is where people have to have an honest conversation with themselves and with their partner if they're in a relationship with somebody. Um, to me, if I'm being totally practical, if my wife and I were to lose both of our incomes, and let's say in this situation we weren't going to have another job until 6 months from now, I honestly don't believe I would make it 6 months without spending a single dime on something discretionary. Like I don't think I would cancel my Netflix subscription for 6 months and never watch another TV show or movie. I don't think I would not dine out a single time. For my own personal comfort, and that I think your example was really really good, and I also like that you have a bucketing approach. For some people, that's also really helpful to be able to visualize where each dollar is being saved and for what purpose. That kind of helps you track what you've set aside. For my own personal needs, when I look at the discretionary part for my own personal emergency fund, I would say, yep, 100% essential expenses need to be covered for whatever months I decide I want, 3 to 6 or even more or less. For discretionary, I'm probably going to pick a percentage of my total discretionary expenses just to give me some maintenance of my lifestyle so I'm not completely depressed. Like, so even if it's 20%, 25% of discretionary expenses, leaving
Okay.
some
So
cash aside,
to
I'm
talk
going to build
in
that in there.
to talk in percentage numbers, hypothetically, if you currently spend 5% of your gross household income on discretionary fun, then
Mhm.
your discretionary emergency account might contain 1% of your gross income just as a fallback. Is that kind of what you meant? So
Yeah, although
1%
I
would
don't
be 20% of the
intuitively.
normal spending.
Yes. I don't intuitively think in the percentage approach. I
Okay.
would say like um if I spend $1,000 a month on discretionary expenses, maybe I would set aside 250 in that 3 to 6 months of expenses, so that if we do go under a period of unemployment, we would have some money set aside to still do some things for
Okay.
our, you know,
That's
for our
fair.
sanity, our mental health.
Absolutely.
But the point of this is that, and I'm saying this to our listeners too, when you get to this part, when you're trying to discern like what percentage of essentials, which is probably 100%, and what percentage of discretionary, that's going to come down to your own subjective needs. Just have a realistic conversation with yourself about what that situation would look like and what behaviorally speaking you could stomach. And I would say that's a good starting point. And once you go through that exercise, you've arrived at your number, right? You've taken your essential expenses and whatever percentage you're covering, and your discretionary and whatever percentage you're covering, and that's your monthly number you have times the number of months you want in your emergency fund. now you have a starting place for your emergency fund.
All right, that makes
But
sense. I think that's fair.
I mean, here's where I want to talk about the 3 to 6 months though. I don't I don't know who came up with this number, but it seems to be taken as like some holy source of truth. Like 3 to 6 months is this golden rule. I cannot figure out where this originated from. I'd be really interested to find that out.
You've been diving deep into the bowels of the internet trying to figure out where it started.
Yeah, a similar project was undertaken for whoever came up with the 4% rule, which is actually something we could talk about in a future episode. The 4%
that
safe
had
withdrawal rule
dated back to the 70s or 80s.
Yeah, and
Okay.
I'm wondering if there's a similar journey somebody could go on to figure out who came up with this
Yep.
3 to 6 months number. Um, I want to introduce a concept here, and I'm going to call it emergency fund risk tolerance. And it's not so different than one's investment risk tolerance, right? I think you could bend the rules here a little bit on the 3 to 6 months, and I mean on both ends, right? Some people dip below the 3 months. Some people dip above the 6 months, right? It just kind of depends on your personal situation. So these are going to be things like, how many people do you have in your household? Like, how the more mouths you have to feed, the more your expenses are going to be. Also, how many incomes do you have in your household, right? Are you a married couple with a single income earner, or are you a dual income household?
That's very true. And
You know,
I have a personal thought there where it also depends on what revenue sources you have. If you are
Yeah.
a couple, my wife and I work for the same company, and in some regards, that scares me to death because if something goes wrong, both of our incomes are at risk, tied to a single company.
Yeah.
And so if you have other skills, certainly build other like sources of revenue, even if they're small side gigs.
Yeah, I mean, I didn't even think of that point, Danny. That's like, think about your employer. Like, do you feel that your employer is financially secure and that they have longevity on their side, that they look financially healthy? You think your job's going to be around? Or is it, a startup? Is it a higher risk employment? I mean, that is going to play a factor in how many months of expenses you want to set aside. Not only that, but think about the industry you work in, right? Like, how marketable are you in your job market or your industry? Like, is this an industry where you could easily, within weeks or just 1 or 2 months, you could snap up another job, you're good to go? Or
True.
or is this something where like your particular job market takes months and months and months until you find another job? That's another factor you have to consider.
You're right. Definitely.
Yeah, and then I mean, gosh, think about somebody who's self-employed, right? Who a business owner. They are entirely dependent on themselves to produce the income. If it's a small business owner, their income may be wildly volatile. It may not be consistent.
Absolutely.
And I know business owners who keep 12 to 18 months of living expenses in an emergency fund.
That's an enormous amount, and it would take a lot of determination and self-control and discipline to build up to that, I think.
Yeah. I've also seen, I guess you could also call it, I mean, this is also being a business owner. Like, if you own rental properties, I do know some people who own rental properties, investment properties that they manage, right? They're landlords, and they have their own personal emergency fund, but then they also have this separate emergency fund to cover expenses just for their rental properties. For, say, example, maybe they have a tenant vacancy for some period of months,
Yep.
right? They still have to make payments on that house if there's a mortgage, and make repairs and pay property taxes and pay for their insurance on it.
Yeah, if you're being responsible and prudent and you own rental properties like that, then I mean you have to put like 3 months worth of rent from every property into a fund to account for depreciation, just
Wear and
normal
tear.
natural wear and tear on these
Yeah.
places. You have to keep them up. I mean, not just for the value of your home, but I mean, literally legally as a landlord, you need to keep these places in good repair.
Right. Right. And so I think the point of this is think about your personal risk tolerance. Think about the nature of your job, how fast you could get a new job. Not to bring up the most recent thing, but the pandemic, Danny. I mean, if ever an event that
Oh,
occurred in
Chris,
our
that's
life,
a no topic. You can't mention the pandemic on any social media. No, go ahead. Go ahead.
there are a lot of people who were unemployed for a very uncomfortably long period of time,
Definitely.
and I can tell you right now, there are people that 6 months of living expenses was not going to be anywhere near enough to cover, the loss of income they had during that
Yeah.
time for some people.
I was
So
furloughed, but only for a very short amount of time.
yeah,
It was nothing like the 6, 8, 12 plus months that many people were out.
yeah. So the point is, think about your personal risk tolerance. Think about the number of people in your household, the number of incomes, in any special situation that may apply to you, and don't tie yourself to 3 to 6 months. If you have a unique situation where it warrants going beyond 6 months, and you have a good reason to do that, you can do that. And same on the opposite end. If you're in an extremely high income household and you would get another job in weeks because you're so competitive, you could stay on that lower end. It's going to come down to some personal factors that you have to consider.
I don't know about you, but one of the things that has always bugged me, like just really irked me about holding an emergency fund, was keeping in a bank and earning 0.001% interest. Right? It's like
Yes,
you literally earn 5 cents, right, on your holdings. It's unbelievable, and it just
yeah,
felt like I knew I had to keep an emergency fund, but by keeping the money in the bank, I was just losing purchasing power and missing out on the potential gains with that money. And so I've always kept the emergency fund, but it's always bothered me. And since moving my emergency fund to a high yield account, I still don't have the price appreciation that you might see in the market over time, but
right.
earning 3, 4, 5%, whatever it is you're getting, makes that loss of potential capital appreciation so much easier to take. Right? At
100%.
minimum, you are accounting for some of that loss of purchasing power to inflation.
Definitely. And I agree with you. I hear it less often now that we're in a high yield environment, high rate environment. People feel less bad about keeping cash socked away in a high yield account when they're getting that 4+%. That feels good. But think back to the low yield environments we were in when bank accounts, you were lucky if you got 1% on a high yield savings account online during those times, right?
Yep.
That can test people's patience. And I
Certainly
agree.
tested mine.
Yeah, I agree with it. I understand that. I share that same sentiment. However, do not underestimate the benefits of an emergency fund on your ability to stay invested in a
True.
volatile market.
Yes.
That lack of growth that you have in a well-funded emergency fund may be the going back to something you said before, the cost of admission, right? The volatility in the market, the tumultuous, the suffering is just part of the cost of admission. It is a lot easier to go through that suffering when you have a well-defined emergency fund that you have deliberately defined in terms of number of months, exactly what types of expenses, essential and discretionary, and you know exactly where it is and it's fully funded. It is so much easier emotionally to stay invested because even if you see a giant downturn in the market or your holdings, you can go, you know what? It doesn't matter. If I were to lose my job today, I am really well covered for all of these reasons.
That
I,
that is an amazing call out, because if you think about how the market moves in its ups and downs, when are, as a society, people most likely to be laid off? During an economic crash.
yeah,
So if you don't have that emergency fund built to weather that depression, that, that recession, that downturn, whatever it is we're going through, then you are literally forced to sell at the bottom in order
Yes.
to pull your money out and continue to fund your survival. If you have that emergency fund funded that you can pull from as needed, then you can just ride out the storm. If you have enough capital set aside and you're comfortable, that is literally the best time to buy. You get into the market when everyone else is afraid, because that's
Yep.
when the money's made, right? If you have,
Yeah.
and this is going a little bit beyond the emergency fund, but when you have capital set on the side, you have the ability to make those smart financial decisions and not be reactionary. You can plan ahead.
I completely agree with you. And I know from firsthand experience, I have seen the market get to very juicy, attractive levels where it's like, oh my gosh, I want to buy so bad. And my emergency fund was not fully funded. And what did I do? I ended up buying into the market at good prices. But when really bad volatility hit, I got really stressed because guess what? I didn't have my emergency fund fully funded. And that was unnecessary suffering that I didn't need to go through. And having that fully funded is going to probably, for most people, make the investment journey much more enjoyable and also have better outcomes, literally. There's just less risk of your behaviors, your emotions, causing you to make bad decisions at the wrong time.
Yeah, I cannot tell you the number of people that I personally know that have pulled from their 401ks and their different retirement accounts to fund or take care of emergencies that come up because they didn't have any money saved.
Yep.
And it's not that a lot of these people didn't have the means to save money. It's just, it's all been spent on discretionary spending ahead of time. And by not having that fund, so many, have to pull from those retirement accounts, and you have to both, you get hit with major penalties, right? You pay taxes on everything, and then you also pay additional tax penalties on it. So you're literally giving your money to the government if you do that, which that's always a big no-no to me. Keep as much money from the government as possible.
Yes, but I want to tie this back to the emergency fund discussion. So you just reminded me of that when you said people pulling from their 401ks and paying penalties. That's one, it's due to them probably not having a adequately funded emergency fund. But two, it was likely caused by some type of unexpected expense or shock that occurred in their life, right?
Yes. I wasn't trying to insinuate that they were pulling for like a vacation. It's just that the discretionary money had been spent on such things.
Right. And I actually want to talk about unexpected expenses. For whatever reason, I've always gotten so frustrated by the just keep 3 to 6 months of expenses rule of thumb, right? Because we've just defined what expenses are, right? They are known expenses. They are essential or discretionary. That's the thing about unexpected expenses. By definition, they do not fit in the term 3 to 6 months of expenses, right? Because you don't know what they are. You can't include something in the term 3 to 6 months of expenses if you don't know what the expense is going to be. That's the nature of unexpected expenses. And that's things like what you were mentioning when we first started talking about this, the car breaking down, some medical emergency and injury, illness, right?
Mm-hmm.
These are not things that are appearing as line items on someone's budget.
A tree falling on your roof. I had a windstorm crack one of my trees in half last summer.
Yeah.
And it happened to fall parallel to my house. But if it had fallen in like the other direction, it probably, would have been tens of thousands of dollars to fix my house.
Right. Oh my gosh.
Yeah. That was unexpected.
Danny, I went through the whole process that we just did with like defining essential expenses and discretionary and what percentage you want to cover of them times the number of months you're comfortable with. I did that with a married couple. And the wife, when I got done with it, like we felt so good, right? Like we had this nice nicely defined emergency fund, and I
Yeah,
want
you
to
have
say it
a
was like,
plan to follow.
yeah, a plan, literally. And I want to say the number was like 40,000 was
Okay.
the number they came to for an emergency fund. And then the wife said, "Hold on a second. Look, I just want to have an additional $10,000 set aside for our house." I was like, "What do you mean by that?" And she's like, "I just in case something happens, I don't want to stress about having to dip into our emergency fund. I want this to be a separate thing I set aside just in case something were to happen to the house." You just reminded me of that with the tree story. Um, and then I realized, look, this emergency fund is a little more complex than just 3 to 6 months of expenses. One, you have to define what expenses even means. And two, we got to think about these unexpected things too. Like this person saying they just want $10,000 set aside for their house. And I get it. Like I can, I can have empathy for that point of view, like wanting that peace of mind. Um, if that makes their financial journey that much more enjoyable and less stressful, then I'm all on board for that. And
Yeah, that makes sense.
yeah, I mean, in terms of unexpected expenses, you mentioned some really good ones, like car breaking down or medical emergency. Something I've always thought was an interesting addition to one's emergency fund was, in addition to whatever your expenses and the number of months you've decided on, you could also set aside an amount equal to your auto insurance deductible and your health insurance deductible.
Okay, that's
That
fair.
way, like if something were to happen to your car, you've got the amount set aside you would need to pay up front before the insurance kicked in.
Okay.
And same with the health insurance. And for the extremely conservative folks out there who have a very low risk tolerance for their emergency fund, they may even go a step further beyond the health insurance deductible. They may do the entire out of pocket maximum. They may say, I just want to know that whatever happens to me health wise, I have the amount of money set aside to cover the worst case scenario. I've also met people who have mentioned that preference before. But
I
the
could
point
see
is,
how that would make sense, because if you have one of those really intense medical emergencies, you're likely not going to be working for a long time.
right?
So you have to
Yeah,
cover the expected expenses, the the just daily expenses, and then you are going to have to cover some amount of the medical cost.
right. Right. And this is, again, this is getting back to the emergency fund risk tolerance and your own personal preferences. Think of things, whether it's auto insurance deductible, health insurance deductible, or simply a fixed dollar amount that makes you comfortable. Like the example I gave, somebody said 10,000. When you've gone through this whole exercise, you now have a well-defined emergency fund. Number of months you want to cover for your expenses, and you've defined what those expenses are. And in addition to those expenses, you've defined some extra unexpected expenses, and you've set a dollar amount aside for that. Again, this is all subjective. It's your personal preference. But when you've defined that and you've actually built a plan and you're actively working towards funding that goal, you are going to feel so much better when you have a well-defined goal and it's funded. Because I think a lot of people get anxiety or frustration because they just always feel like, I just don't know if I have enough money set aside. I just don't know. Like I hear that a lot. Well, if you go through this exercise and you define everything, you're gonna know. Like
Yeah,
that's no longer a mystery. You've done a good job at clearly defining what your emergency fund is and what purpose it serves.
you'll find out exactly what
So
you need, and you'll be able to decide how much you want to set aside for discretionary spending.
right, right.
I had done that in a way recently, where I created a bucket specifically for future vacations,
Mm,
right? So that if I've already allocated the money to vacations, then I won't feel bad if we want to take a more extravagant than usual trip. But I think after this discussion, I'm going to create an additional bucket and start putting just dripping a little bit of money into it each month for discretionary spending if we were to just completely lose our employment.
yeah, I mean, it's important to still be able to afford some awesome board games, right? I mean, that's what's
Very
important
true.
to me when
We
it
do
comes
love
to
board games.
discretionary expenses. Um, but at this point, right, to our listeners, if you've gone through this exercise or you're starting to work it out in your head, starting to get some idea of what your personal emergency fund could look like, once that's defined and you have some peace of mind, you can look at your situation, right? If you are one of those people who is a cash hoarder, like just is uncomfortable with spending anything and you just save a lot of cash, maybe well in excess of what you even need. If you look at your balance and what you've saved, and it is in excess of your now well-defined emergency fund, well, then you have good reason now to put some of that money to work elsewhere. And you could do so without feeling guilty, right? Like you've gone through a very diligent, responsible process of defining this emergency fund. If you're overfunded, you can have some peace of mind knowing that you've done a great job. You could put some of that cash to work elsewhere, pay down debts, invest, whatever it may be.
Yeah, we'll definitely dive into different ways to put that to work in investing later. But
Right.
you had brought up at one point credit card debts and whether or not that should be focused on first, I think.
Yeah, that's a good question. I'm going to come back to that in just a second. To the opposite folks who are underfunded,
Okay.
you've defined your emergency fund and you are falling short of it. You now have a very good reason to start saving more. And Danny, to what you said one other time we were talking, start with baby steps. Start, to use your term, start dripping some money in your fund. You will be surprised at how quickly you can get there. Now, to your point, Danny, what about other priorities, right? Like credit card debts or other savings goals. This is a tough one. This kind of blends into a topic that I think would be worth doing an episode on at some point in the future, like one's personal order of operations, like their savings hierarchy. Like where does my next,
that'd be good. Yeah, that'd be a
where,
really good
where
one.
should I put? Yeah, but again, that's another thing. You search anywhere online and you're going to see all these rules of thumb. Like first start with this and then second start with that. As we probably just demonstrated in this episode, the 3 to 6 months of expenses rule of thumb does not, one, it isn't entirely clear, and two, it doesn't apply perfectly to everybody. The same can be said about one's order of operations and where their money should be deployed to. It's complicated. It's difficult to pin down. I don't think we're going to give our listeners a clear-cut, perfect answer today.
Yeah,
but
I do have a thought on the credit card debt, at least.
Yeah, share it.
So, I mean, I would argue that you get rid of the credit card debt first, simply because if you are literally carrying a balance month over month and you're incurring those enormous interest rates, right, every month, you're losing a huge amount of money. And if you knock out the credit card debt and you're not paying those interest rates anymore, you will be better set up to fund your emergency fund. Whereas if you are trying to aggressively fund your emergency fund while just maintaining the bare minimum with a high interest credit card running in the background, kind of, then you're just going to sink money, right? And lose out on your overall kind of like revenue that you can put towards saving. But, it might be a little different if you create a new card and roll that balance into a 0% card for 12 or 18 months, whatever it is. Then you have a little bit of time and knock them both out, like tackle them equally maybe.
Yeah, I like that strategy. I have actually recommended that to a friend before. And their situation was such that they had a high interest credit card. And the amount in interest they were paying on a monthly basis was very high. And traditional advice at face value, anybody would say, oh my gosh, stop what you're doing and throw money at that debt. Just knock it out. I think the interest rate was like 26%, right? And
yep,
you're not going to get a 26% return on any other investment guaranteed, like you would with just paying off a credit card debt that you're being charged that type of interest on.
In fact,
but
paying
when I
off
took
high interest debt is your only possible way to get a guaranteed return. If you want to argue semantics, right?
Yeah. But I took a step back and I looked at their situation and I was like, okay, they were in a situation where if they were to just deploy all of their cash to that credit card, it left them with nothing. It could have left them with nothing to pay other mandatory obligatory bills. That's a redundancy. Bills that they had to absolutely pay like the next month, right? And the money just simply would not be there, right? So ended up doing a balance transfer to a 0% interest credit card. And I think it was 0% for like 15 months or 18 months. It was a nice period of time. There was an upfront charge. I want to say like 3 or 5% on the amount transferred.
Oh, okay.
That's pretty standard, especially with rates now where they are. Balance transfer offers have become more expensive. I think they're in the 5% upfront fee
Okay.
range now, depending on your credit.
Yeah, I've
But
never done one, so I'm not aware. But I could see how, yeah, that you have to have the money to take care of that.
right, right. But I mean, 5% that you could, upfront and then 0% for 18 months. I mean, it only takes a few months at 26% interest to match the amount of interest you paid on that upfront transfer,
Very
right?
true.
But the risk is like if you're doing a strategy like this, you've got to have your personal savings and spending under control because for somebody who does not have their spending under control, they're just punting off a problem into the future and then maybe taking on more debt and not actually solving their behavioral issues to begin with. And for those people, I don't recommend that strategy. But you're right. It gets messy on what comes first. I need to build up my emergency fund, but I have maybe other debts, credit card debts. Maybe you don't have credit card debts, right? And maybe you just have other debts like car loan or student loans or whatever it might be. Here's the cool thing about paying off those debts. Those monthly payments on those debts are calculated as part of your essential monthly expenses, which get multiplied by a month, the number of months you wanted to set aside, which comes down to a total of what you need in your emergency fund. If you pay off debts and you no longer have those monthly payments, that's going to reduce the demand on your emergency fund, what you actually need to set aside, right? I mean, if somebody has a $500 a month car payment, and they say that I need to set aside, 6 months, but they pay off the car debt loan. Well, now their emergency fund requirement just dropped by $3,000. And so there is kind of like another benefit to some other priorities, other goals that could actually complement your emergency fund. It reduced the demand on it, if you will.
Yeah, there are so many different options and priorities and kind of different strategies you can take. And for people that are listening, or anyone that is listening that's kind of like mired in this stuff and floundering and not sure where to go, talk to a professional. Talk to someone with experience in solving these things.
Yeah.
You could literally have a single 30-minute to 1 hour meeting with someone who has experience in resolving these kind of issues, who would take a look at your situation from the outside in, not someone that's stuck in the weeds, and go, all right, here's your numbers. Here are the necessities. Here are the debts. Here's the plan. And they'll knock it out. And if you stick to it, you'll be in a much better place.
Agreed. And yeah, I think that's so to recap all of our thoughts today. The emergency fund is a critical step in building your financial security and future success. And it not only literally reduces risk, but it has the behavioral benefits as well, enabling you to commit to other financial strategies, investing, whatever it might be, and actually stay the course with less risk of deviating from that course due to stress or volatility in your life. Think about how your emergency fund is defined. Think about what expenses you actually would need to cover and how many months, and take your personal situation into consideration. Really think about it. How many months do you need to set aside given your unique situation with your job, with your family, whatever it might be? Don't forget to account for those unexpected expenses, those things that don't fit into 3 to 6 months or whatever months you choose of living expenses. Think about those unexpected things, whether it's your auto insurance, your health insurance, something breaking down, your house. Come to a number that is comfortable for you and take action steps now to get to that goal. It will absolutely benefit you in the long run, and it may be one of the most critical steps you can take for your future financial success.
Yeah. Thanks so much, Chris. I mean, I think
Oh,
to a certain degree, I've been a little bit humbled. I need to step up my emergency fund game and kind of revisit those numbers a little bit. But it's been great talking through this.
Agreed, Danny, and it's been humbling for me too, and to our listeners too. Danny and I are no different than you who are listening. This is literally my profession, financial planning, and I still am humbled by this topic. Like, I want to go back and revisit my emergency fund too. We're on this journey together, so I'm really glad all of you could join us and take the steps on this journey with us. And we look forward to seeing you next time.
Thanks so much for listening. Everyone have a great week.